Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we're going to solve November 2023 University question paper under the subject Investment and Portfolio Management, also known as IAPM. Again, a very important video for all the TYBMS SEM-V student. In this video, we are going to basically solve all the practical problems that had appeared in November 2023. Okay, more or less around 6 odd practical sums are asked in this paper. So let us see which questions were asked and what is the easiest way to solve those sums. Okay, so we'll start one by one. The very first question that had appeared was under November 2023 paper was, I'm reading out question number 2C. A security return on stock of multi-limited and metal limited under different status of economy are given below. They are given you boom period, low growth, stagnation, recession, probability, and the returns of both those companies have been given. Calculate the expected return and standard deviation of returns of both the stocks, and also advise to invest in one of them. Okay. Now this is a sum based on expected return and standard deviation. So now first we'll have to solve for multi-limited and then we'll see for metal limited. Okay. So first we'll make the table for multi-limited. Okay, the columns will be economic condition, in which we note down the boom period, the low, stagnation and recession. Second is P, that is probabilities 0.35, 0.25, 0.20 and 0.20. Returns of only multi, so that is 50, 45, 30 and 25. The next column will be expected return, that is nothing but P multiplied by R. Okay, so when you multiply P into R, okay, P multiplied by R, we get the expected return. So 50 into 0.35, 45 into 0.25, 30 into 0.2 and 25 into 0.2. When you multiply, you'll get 17.5, 11.25, 65. Add up, we get 39.75 as the total value. This total is nothing but our expected return. So we come to the right side. Expected return ka formula is the total of P into R, which is 39.75%. That is the first thing that we had to find, the expected return. Now for standard deviation, we need 3 more extra column. The next column is R minus expected return, matlab all the values of R minus expected return. So 50 minus 39.75, 45 minus 39.75, 30 minus 39.75, 25 minus 39.75. We get the values as 10.25, 5.25, negative 9.75, negative 14.75. Once we get that, we need to square them. So 10.25 ka square, 5.25 square, negative 9.75 square and negative 14.75 square. So we get the answer as 105.27.95 and 217 point. Once we have got that, last step, multiply the square what we got into the probability. Okay, multiply the square with the probability. So 105.60625 into 0.35, 27 point something into 0.25, 95 point into 0.20 and 217 point into 0.20. When you multiply them, you will get the final amount. That is nothing but the variance part. Okay, so we got 36.77, 6.89, 19.01, 45.51. When you total up, we got 106.18. This is nothing but the total variance. Now standard deviation ka formula is the root of variance, that is the root of sigma P into R minus ER the whole square, that is the root of 106.18. The square root of 106.18 is nothing but 10.3. So our expected return is 39.75 and the standard deviation is 10.3 of multi-limited. Okay, chalo, I hope everyone have got this. I can go through it once and then we'll jump to the second part of the sum where we have to find the same 3 things for metal limited. Okay, now same thing for metal. So again, columns, economic, we have boom, low, stagnation and recession. Probability was 0.35, 0.25, 0.2 and 0.2. Returns were 45, 50, 40 and 30. We'll multiply P into R. When you multiply these two, you'll get an expected return. So 45 into 0.35 is 15.75, 50 into 0.25 is 12.5, 40 into 0.2 is 8 and 30 into 0.2 is 6. Total of that comes to 42.25. That is nothing but our expected return. So expected return is 42.25%. So remember, this is the expected return of metal was much more than that of the first one, that was multi-limited. So keep that in mind. So later on when we'll have to comment, we can comment based on this. Okay. In order to find standard deviation, it will be R minus ER. The next column, so 45 minus 42.25, 50 minus 42.25, 40 minus 42.25, and 30 minus 42.25. We get the value as 2.75, 7.75, negative 2.25, and negative 12.25. Now we need to square them. So squaring will give you 7.5, again 60.06, 5.06, and 150.06. Now last step, multiply the square with the probabilities. Multiply the square with the probability. So 7.56 into 0.35, 60.06 into 0.25, 5.06 into 0.2, and 150.06 into 0.2. We get the values as 2.65, 15.02, 1.0125, 30.01. The total of which comes to 48.69. That is nothing but the total variance. The final step, we have to apply to the formula. Standard deviation is equal to the root of variance, that is sigma p into r minus ER the whole square. That is the square root of 48.69, which comes to 6.97. Now when you compare, they said also invest in many of the one, you have to advise. Now from both the companies, when you compare, Metal Limited, the expected return was higher and the risk was lower. Standard deviation stands for risk. Okay, so lower the risk, the better. Expected return is the return, the higher is better. So Metal Limited mein the returns also higher and the standard deviation is also lower. So we'll have to give, you can give the final answer. Hence it is advised to invest in Metal Limited since the returns are higher and the risk is lower as compared to Multi Limited. Okay, so this is how you will have to solve the sum based on question number 2C. Chalo, I hope everyone have understood. You can note down once and then we'll jump to the next question that had appeared in this paper. Okay, now question number 2D from the same paper. It was given the security return of Q Limited and market returns are given. So they are given you market return and they are giving you return on security and they are asking you to find the beta. Now very simple, for finding beta remember two things. First you need to find covariance and then you need to find something called as standard deviation square m, the formula. Okay, so first we'll make the table. We'll see what all things are required for the table. The first step for Q Limited, particulars may we have 1, 2, 3, 4, 5, 6, 7. RS stands for return on security, which was 10, 13, 15, 14, 15, 18 and 20. Total it up, it comes to 105. And return market return, which was 14, 16, 18, 20, 22, 24 and 26. The total comes to 140. Step first, note down these 2-3 columns, get the total, and now we need to find the average of this total. RS and RM we have. We need to find RS bar, that is the mean of RS, and RM bar, that is the mean of RM. So for RS bar, it will be sigma RS upon N, 105 upon 7, which comes to 15. RM bar ke liye it will be sigma RM upon N, 140 upon 7, which is equal to 20. Okay. First step, we need to find the average of RS and RM. Now next, for the next thing, why did we do this? For the next column, the next column will be RS minus RS bar. So all the values of RS multiplied by RS bar. So 10 minus 15, 13 minus 15, 15 minus 15, 14 minus 15, 15 minus 15, 18 minus 15 and 20 minus 15. We get the respective values as negative 5, negative 2, 0, 1, 0, 3 and 5. Next, we need same thing but with the RM. So it will be RM minus RM bar. So all the values of RM multiplied by 20. So 14 minus 20 is negative 6, 16 minus 20 negative 4, 18 minus 20 is negative 2, 20 minus 20 is 0, 22 minus 20 is 2, 24 minus 20 is 4 and 26 minus 6 is, 26 minus 20 is 6. Okay, so these are the next new 2 additional columns. Now we need 2 more additional columns. The second last column will be called as RS minus RS bar into RM minus RM bar. That is nothing but the product of the 2 columns that we just now found. Okay, so minus 5 into minus 6 gives you positive 30, minus 2 minus 4 is positive 8, 0 into anything is 0, 0 into anything 0, 0 into anything 0, 3 4s are 12 and 6 5s are 30, and the total of that comes to 80. Last column that is required is the RM minus RM bar ka square. So negative 6 का square is 36, 4 का square is 16, 2 का square 4, again 2 का square is 4, 4 का square 16, 6 का square 36, total comes to 112. These are the two values that are required to solve further. Okay, chalo, this is the entire table which is done. Now once that entire table gets done, the next step is to find covariance. Covariance का formula is sigma RS minus RS bar into RM minus RM bar the whole upon n minus 1, n was 7. So the numerator is this value 80 divided by 7 minus 1 6. So when you divide you get 13.33. Next step what you need is standard deviation square m. That is the total of your last column upon n minus 1. So 112 upon 7 minus 1 we get it as 18.67. Once you have the covariance and standard deviation square m, we can apply the beta formula. Beta is nothing but covariance upon standard deviation square m. So 13.33 upon 18.67 we get a beta as 0.714. So this is how you have to solve the sum based on calculation of beta. So you can go through it once. You can even note down the formulas, important formulas, simple formulas. Okay, this was question number 2D. Let us take now the next question which had appeared. Question number 3 was based on, like, it was theory or ratios. Okay, now this question number 3 was based on ratio. They are given you balance sheet, they have given you liabilities, and they are given you all the assets. Market price per share is given and dividend per share is given, and they are asking us to find certain ratios. The very first ratio is called liquid ratio. Liquid ratio is nothing but quick current asset upon quick current liabilities. Under quick assets we have debtors and cash. Under quick liability we have creditors and outstanding. So based on that we can apply it into the formula. Liquid ratio is quick asset upon quick liability, debtors plus cash, creditors plus outstanding. 1,75,000 plus 45 upon 85 plus 55 we get 2,20,000 upon 1,40,000 which comes to 1.57. So the liquid ratio is 1.57. Second is earning per share. Earning per share ka formula is basically, net profit after tax minus preference dividend upon the number of shares. So basically earnings available to equity shareholders. So here they have not given you P&L, but they are giving you general reserve. So we consider that as a part of a reserve. Preference share ka dividend we'll have to calculate. That will be 10% on 3 lakhs. So that is 30,000. So earning per share is 1,80,000 minus 30,000 divided by number of shares, which is given as 6,000. So 1,50,000 divided by 6,000, the value comes to rupees 25. So the earning per share is rupees 25. Next is price earning ratio. Price earning ratio ka formula is very simple. Market price per share upon earning per share. Market price per share is given as 230. Earning per share we have found as 25. So price earning ratio is MPS upon EPS, 230 upon 25. So which comes to 9.2 rupees. 9.2 earning per share. Okay, that is. Next is dividend payout ratio. Now the dividend payout ratio ka formula is dividend per share upon earning per share into 100. Dividend per share is given as 20. So we apply the formula dividend per share 20, earning per share is 25 into 100. So when you divide and multiply, you will get the answer as 80%. And last, dividend yield ratio is the same formula, but instead of earning per share, it will be market price per share. So dividend yield is DPS upon MPS into 100, 20 upon 230 into 100, which comes to 8.7%. Okay, so this was a sum based on ratio analysis where they had asked us to find 5 ratios. So you all can note down once, then we'll jump to the next type of sum. Okay, the next question was question number 4C. The information of 3 portfolios is given below. They are giving you one of Penn Limited, Balaji Telefilm, Warner Brothers, and then they are giving you some market index. The average returns, beta and standard deviations are given, and compare this portfolio on performance using Shah and Trenor's measures. The risk-free rate of return is given as 8%. Okay, now this is very simple. You just have to apply into the formula. Okay, so now I have already created a table for that. So a table will be measures in which you have Sharpe's and Trenor. Formula Sharpe's is R, that is the average return minus risk-free return upon standard deviation. So for Penn, okay, the return was 18, risk-free return is by default 8, okay, and the standard deviation was 0.48. So basically the formula would have been 18 minus 8 divided by 0.48, which comes to 20.83. For Balaji it was 19 minus 8 upon 0.38. For Warner it would be 22 minus 8 divided by 0.28, and last 24 minus 8 divided by 0.32. So when you minus and when you divide, you get the answer as 20.83, 28.94, 50 and 50. For Trenor's, the formula is, the numerator remains same, return minus risk-free return upon beta. So it would be 18 minus 8 upon 0.9, 19 minus 8 upon 1.4, 22 minus 8 upon 1.1, and 24 minus 8 upon 1.0. So when you minus and divide, you will get the answer as 11.11, 7.86, 12.72 and 16. Very simple sum. Just have to apply the formula, substitute the value and get the answer. Okay, this was sum based on question number 4C. So you can note it down once. Okay, now the last question, question number 4D. Okay, now the last question was question number 4D. The following information, the securities are as follows. Godrej, Durian, Nilkamal and Markand return have been given. Risk-free is 7%, and for each return finds the rate using IAPM method and identify whether they are undervalued, overvalued or at market and advised to invest. Okay, in that case we'll have to first find for Godrej the returns or the rate of return. So the formula, okay, the rate of return is equal to risk-free return, which is 7, beta for Godrej is 1.5, the market return is 24 and risk-free return is 7. So we just apply to the formula 7 plus 0.5 into 24 minus 7. So you first minus, you multiply it by 1.5 and then whatever answer you get added to 7, you will get 32.5%. Same way for Durian, it would be 7 plus beta is 1.2 into 24 minus 7. So you minus, you multiply, you add, you get 27.4%. For Nilkamal, in the same order, it would be 7 plus 0.8 into 24 minus 7. You multiply, you minus, you multiply, add to 7, you get 20.6%. And last is for market index, also we'll find and we'll keep it. So 7 plus 1 into 24 minus 7. Okay, you minus, you multiply, you get it as 24. So this is the return. So we found all the returns. Now we need to compare and say whether it is overvalued or undervalued stuff. Okay, so we make another table for that. The columns are, the shares, the expected return, the actual return, and then the observation. Okay, the expected return, actual return, and then the observation. So now remember, the logic is very simple. So expected is all these values which they are given us, the actual is whatever we have found. Now we compare. When your actual is more than your expected, the share is undervalued. Again, when your actual is more than your expected, it is undervalued. When your expected is more than your actual, it is overvalued. And if both of them are same, the market basically is at par. So this is how you have to say whether it is overvalued or undervalued. And last statement you have to make whether to invest. Now, whichever shares are undervalued, you should always invest in that because the share has potential to grow. Okay, it is undervalued. So here in this case, Godrej and Durian were undervalued. So you write it is advisable to invest in Godrej and Durian. Okay, so this is how you all had to solve question number 4D. So that was the last question under this particular question paper. Okay, so we started with expected and standard deviation, ratios, CAPM method, Shah trainers, all different types of sums were asked in this particular paper. Each and every sums have been solved. So I hope everyone have understood that. With that, we will be ending this video here. Thank you.